in Bitcoin or any other financial currency? Check the box, yes or no. Yeah. Anybody filing Schedule 1?
Isn't that going to the page 1 and 2 of the return this next year?
You are a half step ahead of me, man. Here I am trying to lay it in and give you the build up and all, man, and you're just boom. No. Actually, I love it when that happens, and somebody's a half step ahead of me. Yes. For those, he was asking, isn't this going to? Yes, this is going to show up on page 1, front and center of this year's 1040, rather than Schedule 1. Last year, only people who filed Schedule 1 had to answer that uncomfortable question. And if you didn't have any adjustments, or you chose not to take them, there were some people I heard who chose not to take IRA, make IRA deductible contributions and do other things in order to avoid having a Schedule 1. Now, the interesting thing about this, it's just a dumb little yes-no question, right? But as such, it is covered under that signature line on the return. Under penalty of perjury. See Lunch with Bernie Madoff or the Trump campaign associate of your choice on an extended basis. Yes, perjury. Criminal charges for both the client and the preparer, the signing accountant. Oh yeah, they can hammer our butts for that too. What the IRS was really doing here was setting everybody up for criminal charges just like they did with the foreign bank accounts. You said you didn't have any of that. So when they find out you did, not only do they drop the hammer on you, they threaten you with the big house. And that's when generally people roll over, play dead, throw money at the IRS, please don't send me that, shack up with Lori Loughlin for a couple weeks. Oh yeah, they're setting you up. You talk about a perjury trap. Well, this is a perjury trap for taxpayers. And this forced you to get a straight answer to that question from a lot of your clients. Did you or did you not? Now, I'm sure the question was asked in your organizing. What percentage of your clients actually return the organizer to you? Probably less than half. Of those that do, aren't about 3/4 absolutely blank, empty? You can tell from the corner they've never even opened the dumb thing, they just send it back to you. We get to shred it and recycle it for them. Yeah! So we had to go and ask this. How do you treat Bitcoin? The IRS took an interesting position 5 years ago. They said it's not currency. You don't treat it like money, like British pounds or Japanese yen or euros or whatever. You treat it as property, as if this year, instead of Ripley giving you a Christmas bonus in cash, they give you certificates of Apple stock or Bitcoin. Well, if they give him Apple stock, how do we treat it? Well, okay, we figure out, well, it's going to be taxable compensation. He gets it at equal to the fair market value of Apple on the date that we blah, blah, right? And then when he uses that Apple stock, he sells it, or he goes and he buys a new car and he gives that to the dealer for the down payment or whatever. We figure out what's its fair market value then, and the difference is going to be a capital gain, short-term or long-term, based on his holding period. That is how we deal with virtual currency. Same as if it was Apple stock or anything else. And they ruled last year on hard forks and airdrops, which I had no idea what the fun they were talking about. I had to read that 3 times. It's like, okay, stock splits and spin-offs and stuff like that. And then last year, they started sending what they called educational letters to clients. I believe they've been suspended this year due to the COVID. The IRS has not apparently been doing it, but they sent out letters to people saying, we have ways of knowing these things. We know that you had an account at Coinbase or one of the other exchanges. And so this might be a really good time for you to review your tax return, and if on second thought you don't think you've reported things correctly, now would be a good time to amend that before we come after you. That's what you get reading between the lines of those letters. And how do they know you had, well, just like the foreign bank accounts, they've been sending John Doe summonses to the exchanges and getting lists of their account holders, just like they did to UBS and the other foreign banks and brokerages. Oh yeah, they have ways of finding out. Well, okay, here you go. He was ahead of me, bless him. Look at this. What happened right there? Oh, at 2020, did you do any Bitcoin? Oh, yeah. Now, everybody has to answer that very uncomfortable question. Yes or no, under penalty of perjury. Well, that's not a big, nobody does that, right? Heck, a year ago, I'm seeing on the news that more than 10% of all Americans have dabbled in Bitcoin. You know, yeah, and a lot of them were speculating and, you know, all of that, and they lost their shirt. Okay, when the price collapsed and all. Oh, man, they took it on the chin. But some of them did quite well. Some of them are still in the game. We need to get the answer to that and then deal with it. Whatever it is, for better or worse. Oh yeah. Front and center, all taxpayers, regardless of income, are going to have to explain. All right. Charitable contributions, huh? Remember we talked about that $300 above the line deduction? Here you go. Line 10B added to the return, added to the form this year. Right after my adjustments coming in from Schedule 1, I get charitable contributions if you take the standard deduction. And so yes, this is an either or. If you don't get this and then also get the chance to choose whether to itemize and to claim additional charitable contributions then. The amount, what do I got here? Hold off on that. The amount is $300 per return. Married couples, only $300. Yes, that is a marriage penalty. And then look at this one. My federal withholdings get split up. It all used to be on one line. And now for this year, they're going to break it out. What was withheld on W-2s versus what was withheld on 1099s. And also note that this year, the 1099s may look a little different for some of your peeps, because they have resurrected an old form that some of you may remember, Form 1099 NEC, for non-employee compensation. That is now the correct form to use when you are paying your independent contractors. And so you guys may have independent contractors, your clients, some of your clients, I have no employees, only independent contractors. Oh, sheesh, forgive me, people. Everybody with a pickup truck and a hammer is not an independent contractor. I call bull, but some of them play that. How about your Uber drivers and Lyft and, HelloFresh and all of those folks? A lot of that's going to be on a 1099 NEC, and many of those operations have been offering their drivers and contractors the opportunity to withhold and deposit. Because otherwise, the Uber driver gets to the springtime and has all of this money and no withholdings. And yeah, maybe they are only paying 10 or 12% tax rate on their income. The real problem is, you pile on 15.3 for both halves of Social Security, and they're all of a sudden in a world of hurt. That's one way to avoid that problem. So IRS is breaking this up. I think this bifurcation is going to also make it easier for them to trace and or match up the withholdings with the returns. The recovery rebate. Remember we were going to reconcile it? We see this coming in here on line 30, recovery rebate credit. And that's where if your client was understimulated, undersubsidized this summer, we can get the extra money. For example, if they had a child during 2020, that would not have been in the IRS computers looking at their 18 or 19 return. We ought to be able to get them something. If their income was higher in 18 or 19 pre-pandemic, and now they're falling lower in or fall out of the AGI phase out, we can get them more. Here's where it shows up. And it comes through as a refundable credit, which means, yes, not only can we wipe out any tax liability, they can get a check back from the IRS. Within the draft instructions to the 1040, came out about a week and a half ago, the IRS has a worksheet to calculate that. I don't expect any of you to have to work on that worksheet. I would hope your software provider now has enough time to deal with that and get that all programmed in and working for you. But if prior to that, as part of year-end planning, some of your clients are badgering you about it or wondering what it's going to look like, I would use that as a tool to take me through the calculation and help them estimate where they come out. And again, you may hear some panic phone calls from people or email if the check they got this summer is bigger than they were with 2020 hindsight entitled to. No, they don't have to pay it back. We're not going to punish them and take it out of their refund or anything of the sort. Now, the conversation we were just having, the IRS has said the government is not going to be sending any kind of extra letter or notice or 1099 equivalent or 1099-G for government payment or anything to show us how much they got for a summer COVID stimulus check. We're supposed to be telling our clients to keep and send us a copy of what the IRS called Notice 1444, your economic impact payment has arrived. You have a copy of yours in your phone. You're like me. You all did. We get stuff like that. We have a file at home or in the office. We put it in. We slide it there. We keep all of that stuff during the year. We have it. I'm here to tell you, your clients are generally not like us accountants. They don't do that. They don't keep it. They do, what's the time? I hope they kept it. I hope they put it in the shoebox where they collect all their tax stuff during the year. But I have my doubts. He was asking, will the IRS have some kind of online lookup feature that we can go to and do all kind of like the where's my refund thing or whatever? At this point, they're not making any warm fuzzy noises about that. At this point, it hasn't been promised or offered. And there's all kinds of identity theft issues that they have to deal with, that being hacked and all. So I don't know if it's going to come to help us out. And if not, we are being set up for trouble and problems and all the rest. I would say that the lack of that kind of stuff from the IRS, this is not the only one of those problems you're going to have this year. They have also said that the SBA and or your clients' banks will not be filing 1099-Cs or any other kind of notice regarding the cancellation of indebtedness when their PPP loans are forgiven. We're not going to get anything to help us figure out what that either. So, are you starting to figure out that you're kind of on your own here you guys? Might be kind of lonely to be an accountant going forward, just saying. All right.
I have a question.
Yes, sir.
Do you know if the federal unemployment kicker will not be included on their unemployment connection?
For our imaginary friends.
Wake up.
Yeah, get your pants. The question is whether the additional $600 of federal unemployment will show on that on their 1099 with the statement. I have not seen that explicitly answered. However, I believe the answer will be yes. The reason is that was processed through the state unemployment offices or agencies. And as such, I believe they, as the payer, are required and will, in fact, be including that additional $600 a week on what they report to us.
With no withholding? Yeah.
Well, yeah, that's that other problem. Because although you can have you understand that unemployment, or as one of my friends calls it, unenjoyment, is always absolutely 100% taxable income. People assume it isn't. Wishful thinking. Actually, that's because in Michigan, I think our maximum benefit is like $365 a week. Well, if you've been laid off, you've lost your job, $365 a week is not enough to pay the bulldog. You know, that ain't going to help you. That ain't going to take care of your rent or your mortgage and the utilities and all the rest of the bills of the household. So when they have the option to have taxes withheld, they say no, hoping that they'll get called back, they'll find a new job, or somehow this won't be a problem. So they get $365 a week for 10 weeks. And so we find out that means there is $3,600 of taxable income on that return with absolutely no withholding. Do they have money in the checking account to pay the taxes on $3,600? No! They've been trying to squeak by. Well, now look at the problem we got, people. Now for 10 weeks that they were laid off, it's not $3,600 of taxable income. It's $9,600 with no withholding. We're going to have some horrible problems on a lot of those returns come springtime. You are absolutely correct. We want to try and warn some people on that. All right. Remember I said that the president in the executive order couldn't do it. All he could do was play around with the employee Social Security withholding. Because we'd already promised or given away the employer's 6.2% of Social Security. That was done in the CARES Act. And in the CARES Act, we allow businesses, employers, to defer payment of the employer's 6.2% half of Social Security. Now, this is the employer tax. So if things go really bad and they go under, this one should not have the 100% penalty on responsible persons. I guess that's small comfort. Well, for most of your clients, if they're choosing to do this, or if we decide to do it at year end, That happens like on the 941s and things like that. The important thing for you, thinking about individuals on the 1040, is it also applies to your self-employed people. People working for themselves, Schedule C, Schedule F farmers, partners in a partnership. They have the opportunity to delay payment of their half of Social Security. So I go down on the 1040 and I come all the way through, and you see, and I like the way they phrase it. I don't think that, isn't it usually say amount you owe? Look at what the form says now. Amount you owe now. And then they give you a warning. It says, note Schedule H. Quiz question. For an extra bag of chips at lunch, who knows what Schedule H is? Household, right? When you hire the nanny or whatever working for you, household employees, you got to do the social, that's where we report that. That's where you function as an employer. So yeah, you've got working for you the nanny, the gardener, Jerry Falwell Jr.'s pool boy, people like that. That's where we're supposed to report their taxes. Or Schedule SE filers for your Schedule C, F, and partners in a partnership type people. The amount you owe now may not represent all the taxes you owe for 2020. Oh, we got something. Now, this is not required. This delay is not mandatory. If your people have the taxes, the cash in the bank, and we don't want to worry about this problem down the line, you don't have to do these things, but you may. And so on Schedule 3, additional credits and payments, I have my non-refundable credits for education and all of that, and then my other payments and stuff. My net premium tax credit, amount paid with request, excess Social Security in Tier 1. Remember we talked about that for people who work for 2 jobs and go over the Social Security wage base. Oh, and then here, Part 2, line 12E, deferral for certain Schedule H or SE filers. See, we show, isn't it on like Schedule 2, our SE taxes? And so the way the IRS chose to reflect this delay or deferral on the forms is to put it in here as if it was a refundable tax credit on your 2020 return. And then we assume the IRS and your tax software will carry that over to next year, and so you will then show the repayment or the reversal of this 50% in 21 and 50% in 22. Because that's when it gets paid. I mean, effectively, Congress is giving you a loan of the employer's Social Security. And then it balloons. 50% balloons next year, 50% balloons in 22. You get a 2-year spread. Interesting thought. I'm currently self-employed. I don't know that I'm going to take advantage of this opportunity myself. I'm an accountant, man. I hate contingent liabilities. I hate knowing these things are waiting on. I don't know what's going to happen to my cash flow next year. 2020 has not been kind to Doug. If I can take care of this problem now, I think I will. But some of you probably have clients who are fighting for the very survival of their businesses and or their families. You got restaurant people that are closed and can't, and This may be a lifeline that they're willing to take and grab, and they're going to need to do it, and we need to be prepared to give them this opportunity. Note, however, that will be a liability you got to plan on next year. And it's one thing to know it's there and to make sure that their estimated tax payments during the year are 100 or 110% of their 2020 liability. And then just worry about how it balloons. On the other hand, this is going to be part of your total 2021 liability. That if you're trying to come in low on the estimated tax payments at 90% of your 21 actual tax, this is going to be part of that total tax that you got to have 90% of paid in as part of your estimate. Game on, people. Game on. Ah, yes. Medical expenses. You may remember that the Affordable Care Act raised the threshold for deducting medical expenses from 7.5% of AGI to 10%. Why? Was it really for the money? No, it had nothing to do with the money. What do we expect as the bare minimum of all Americans under the Affordable Care Act? Guy like him. What is the bare minimum we expect? Demand. The Affordable Care Act demands that he must, by hook or by crook, obtain adequate health insurance for himself and all of his dependents, and that he must be willing, happy to pay up to 9.5% of household income for that, whether it's withheld out of his paycheck by the boss, or whether he pays that portion of the premium on the government exchange at healthcare.gov. 9.5% of income is the bare minimum we expect of everyone. Well, if all he's doing is the bare minimum we expect, 9.5% of income, what makes he think he gets a tax deduction for that? That'd be like double dipping. We're not going to let you do that, my friend. So we raised it to 10%. Now, it makes a few things interesting. You know that for years we have tried to train our clients, do not send me your medical bills or receipts. Don't. Can't, unless you have a baby, somebody's got cancer, or we're talking assisted living, don't bother. Not going to be deductible. Okay. Well, if he's paying after tax 9.5% of income on the exchange for insurance, how much does he have to save in medical bills before he can itemize? Almost nothing. And so what do we have? The return of the shoebox. You remember the shoebox returns. They bring you the shoebox with all of their medical bills, and you get the joy of running the tape for all the doctor's bills and dentists and optometrists and orthodontics and all the prescriptions from Walgreens and Costco. And there is way too much information there, people. I don't want to know how often they refill the Viagra prescription, but sometimes you just can't unsee. You can't. So now we're doing it. But there's a problem. When you think of blocks of clients who have enough medical expenses to itemize, who comes to mind first? The seniors, right? Let's be honest. As people get older, we go to the doctor more, we have more prescriptions. Eventually you need a knee replacement surgery or hip replacement. Crap. Last year I had cataract surgery, both eyes. I am too young for this, people. And then maybe it's assisted living, right? You think of this as this was going to be, you want to talk about an age tax? This was an age tax on the AARP. Absolutely. Well, we can't have that. You know that everybody in politics is afraid of senior citizens. Not because they're going to wear black shirts and riot and burn things, senior lives matter. No, but because they vote, people. They vote like nobody else. And so we're afraid of them. So in the Affordable Care Act, they cut a deal and delayed it for 4 years. In 2013, 14, 15, or 16, if you or your spouse had celebrated your 65th birthday, you could use the 7.5% of AGI, not 10. A strong congressional endorsement of cougar dating. But that had expired at the end of 2016. And so here we are coming on down to the holidays, Christmas of 2017, pushing out the TCJA. And many of our older Americans, voters, were going to find themselves a nasty tax hike in the spring of 2018. Oh no, we can't have that. So Congress pushed it off again. Rolled it back to 7.5%, not just for seniors, but for everybody, including the young whippersnappers too, which I found very helpful for parents with high deductible health plans who are having children, as well as for parents with high needs or special needs children. If you know anything about them, they have a lot of bills and specialists and all of that kind of stuff. So this has been very helpful for them. Also understand that anybody paying out of pocket after tax dollars for insurance on the exchange or on the individual market, you need the shoebox. We should be at least looking at whether they can itemize. They did this for 17 and 18, and so here we were again, coming on down last minute last year. It was going up to 10% for everybody, even older Americans. So in last year's extenders bill, yes, the Further Consolidated Appropriations Act with the comma, Congress rolled it back and held the line at 7.5% for all taxpayers, regardless of age, in 2019 and 2020. And so we're good for this year. You can see it on the draft Schedule A, line 3, multiply my AGI times 7.5%. It's here now. We're good to go this year. All bets are off in 2021. Okay, a couple tweaks and updates on Code Section 199 Cap A, the all-important 20% deduction. It's interesting to watch the speculation on whether or not that deduction is on the bubble under the new administration or not. Originally, both Biden and Harris said they would repeal all of the Trump tax cuts, which would clearly include 199A. They backed off of that, actually both of them dropped that after the Democratic primaries. Now it's going to be selective and only over. This one hasn't been talked about at all. At one point, there was talk, particularly from Harris and Sanders, that 199A would be repealed, like on the first day of the new administration. There's a certain problem with that. Tony Nitti, writing in Forbes magazine, says it's kind of interesting because Joe Biden used 199 Cap A to save $500,000 on his 2017 or his 2018, 2019 returns. So he may have a little skin in that game. We'll see. Hey, I want to know how much Hunter saved with 199A. Remember that even prior to potential changes, people who make too much money can lose the very important 20% deduction. For this year, these limitations kick in at 163.3 single, 326 married couple. Now this is taxable income. And so to the extent you can manage, massage, maneuver your taxable income to get under those lines, you can avoid both the limitations. The one hand, I like to phrase it this one, you have to be able to support or justify your deduction. This was supposed to be the Tax Cut and Jobs Act. And we want American jobs, real jobs, W-2s, fringe benefits, health insurance. And so you got to support, hey, if you're not creating American jobs, what the heck makes you think you deserve a special 20% tax deduction? I kind of get it. Over the threshold, you better be paying people on a W-2 and not just a host of independent contractors, or we take away your deduction. Or you better have a boatload of depreciable assets, real investment here in the U.S. to support your deduction. And over that threshold, you lose your deduction if you provide the wrong kind of services. You stinking accountants, lawyers, doctors, consult, all kinds of people. Got it. We all think, and many of you learned the 157.5, 157.5, 315. Hey, you just need to put this one into your mind. Maybe write that number down, put it on a Post-it note on your wall or cubicle, because that's your target this year. Your mission is to make sure that clients who are subject to the phase-out come in under that target. And for those who are going to be over, one of the year-end planning things that you need to do is to rough out where they're going to be on their W-2 wages and whether they're going to have enough to support their deduction. I worry about that for people who've had a lot of their people, laid off, furloughed, whatever. We're not paying them. My W-2 wages are down. Or for some of your self-employed clients who have been able to pay themselves a salary out of their S-Corp, and their W-2 wages paid to themselves can support their 20% deduction. They've had a lot of payless paydays, and so we can't plan or count on that. So this is one thing I would encourage you as part of your year-end planning with folks to just feel out and find if we got it. To the extent our payroll has been anywhere comparable to last year, if they've been just taking a loss and paying people to keep their workforce, ready and available and all of that, then we'll be fine, particularly with the income down, but I worry about some. Might be worth looking into. And you remember how under 199A, business deductions are taken into account or subtracted from your taxable income to determine your QBI qualified business income. And sometimes it sort of almost makes sense, like the 50% deduction you get for your, the half of Social Security you pay for yourself when you're self-employed. If I was able to take that into business, my taxable income there would be down, and okay, maybe. Qualified retirement plan deduction, okay, I kind of get that one too. Never quite figured out the above-the-line deduction for health insurance. Think of this, when you are a S-Corp shareholder and the company buys or pays for your health insurance, can you get that as a tax-free fringe benefit? No. And when the company pays your health insurance, it's non-deductible. M1. However, since IRS Notice 2008-1 made it real clear, the S Corp is supposed to, include your health insurance premium in Box 1 W-2 wages. Not Box 3 or not Box 5. It's not Social Security or Medicare wages, just Box 1 taxable. And then you get to take then the S Corp gets to deduct it as wages compensation to the S Corp shareholder. And then the shareholder gets to take the 100% above the line deduction for AGI on their return. So understand, when you do it correctly and W-2 it, that premium has already been deducted from taxable income and therefore from QBI. And then the IRS requires you to subtract it again. They're double dipping, people. You're taking a double hit on that. That ain't fair. Same thing happens to partners in a partnership. How do we book their health insurance premiums? Doesn't that become part of guaranteed payments to partners? So it's non-deductible. It pumps up the taxable income of the partnership. It's in guaranteed payments, which are not 199 eligible, and then we make them subtract it again. Double dip. That is cheap shot. That ain't fair. Well, then do you remember this one? Last year, the IRS slipped something into the instructions to the 8995, which is where we do the 20% deduction, right? Yeah. And they said there, in the same way that you have to subtract 50% of SC taxes, qualified retirement plan dollars, above the line deduction for health insurance, when you have that partnership or S Corp making charitable deductions out of the business account, separately stated deduction passing through on the K1 for the owners to take on Schedule A, that is a business expense, business deduction, which must also be subtracted from QBI. Now let's be honest. Many of our business clients are quite generous. They support organizations that are close to their heart. And they want to be a good member of the community. I get it. I support it. And they tend to write most of their charitable checks out of the business account. Why? That's where the cash is. That's where the bookkeeper is. Okay, write checks to the United Way and, they can do that there. And it also allows them a degree of anonymity. Not everybody knows, who actually owns, Boise Tire and Auto. Some people do, but not everybody. It's a way for them to keep their name and their personal, out of, bit under the radar. Cool. But do you understand, under this, when your client made $10,000 of charitable contributions, honest to God, well-documented charitable donations out of the business account, that $10,000, then you subtract this, that takes away $2,000 of their $199 deduction. What a raw deal. And so a lot of us have spent this past year trying to coach or train our clients, stop it. Don't do that anymore. Please don't make charitable contributions in the business. Instead, take a distribution personally. Put that into your personal checking account and write your checks to the United Way or your church or the food bank or the home for unwed animals or whatever it is, and to write those personally. And don't hurt yourself on the 20% deduction. Just when we thought we were getting a bunch of them clients trained, I think the IRS caught it for this. I think they caught a lot of flack for that bit of crap. And so the draft 8995 instructions that came out a couple weeks ago, one of the most notable changes is they have dropped that language and the crazy thing, directing the subtraction or add back of those charitable contributions in my 199A calculation. All right. Then you vaguely remember, I mean really vaguely, and when we started learning about this after the 2017 Act, there was something about, well, if your net qualified items, if your net QBI for the year is negative, less than 0, we have to remember that. Carry it over, carry it forward, and treat it as a QBI loss in succeeding years. Now, we kind of knew that thing was there, but did anybody worry about it or do it? No, because this was 2018 and 2019. The economy was good. People were making money. We were looking about taxable income and the 20% deduction. We weren't talking about this. Now, welcome to 2020. So how is this supposed to work? You had a client who 2018 had $100,000 of taxable income, QBI. You took a $20,000 deduction, didn't you? Yeah, you were supposed to. 2020, 2019, they were doing even better. $150,000 of taxable income, all QBI. 20%, that's like a $30,000 deduction. 2020, the COVID hits the fan and they lose $200,000. Now, assuming you have basis, at risk, they were an active material participant, they weren't passive, we are now able to deduct that in 2020 and maybe even carry the loss back, right? Cool. But you have to remember that 2020 loss. And so now it turns around in 2021. We get a vaccine, we get herd immunity, whatever it is, and the economy and the world and their business picks up and recovers. And they make $300,000 of taxable income in 2021 for an extra cookie in the afternoon snack. Who can tell me what their 20% deduction is in 2021? $300,000 of QBI taxable income. How much is their 20% deduction? It is not $60,000, people. Why? Because even though we fully deducted that $200,000 loss in 2020 and carried the NOL back and all of that, we had to remember this and carry this forward for QBI purposes only. And so my net QBI in 2021 is not from my $300,000 taxable. I have to subtract last year's $200,000 loss. I will only have $100,000 of net QBI in 2021. I get a $20,000 deduction against my $300,000 of taxable income. How do you like them apples? Although this was there and you kind of knew about it, the IRS really didn't do anything about it. Because, you couldn't have this problem previously, and nobody really did. No, that carryover doesn't affect my ability to use my losses in 2020, deduct them now, NOL carryback, or anything else. Note, if my QBI from a business is less than 0 in the red, I don't get to use those W-2 wages or depreciable basis against other QBI this year, it doesn't get carried over to next year. So, no, none of that. Don't you try it. Don't you dare, people. This year's, the IRS has realized what may be afoot. And so in the draft instructions, they have both a couple warning paragraphs that say things like this. What's new? A method to track those 2020 and other QBI losses. In fact, maybe somebody had this in 2019, or they will from 18 or 19 as we amend some of those returns and make those changes. Claiming our qualified improvement property and others. We're going to see some of those numbers turn. A worksheet has been added to provide you a reasonable method to track and compute your previously disallowed losses or deductions. And they have put a worksheet to do that into the instructions. Part 1 where and it's great. Enter the code section limiting your loss. So I may have losses limited to all kinds of things, basis, at risk, 469 for passive, whatever. So I can have a different one of these for each one of those flavors or losses of suspended losses. What's suspended in the year of disallowance? What is my QBI fixed percentage? What percentage of that is qualified? Note, for pre-18 losses, which predated 199A, the IRS form says it's automatically 0 because it doesn't count against me here. Okay, how much was allowed in prior years? What's still limited by other code sections? And then part 2, what's my non-QBI suspended and allowed versus my QBI suspended and allowed? This, I think, is going to be very helpful. Some of you are going to hope, assume, wish, maybe even pray that your software is just somehow going to automatically do this and do this right for you, that you don't have to understand it. Kind of like you really have no idea how it actually does the whole passive activity loss limitation and allocates that between the different kinds of stuff. I don't know. I hope CCH Pro System does it right. Can't you do it like that? I understand that. I'm not sure your software is going to be able to do this correctly this year. This is new, this is different, and those programmers have a heck of a lot to deal with the CARES Act and the COVID and everything else. I am not convinced the software will be fully functional on these folks. In fact, it may be just where it's effectively dropping in, numbers into what looks like a PDF This is one that when you have qualified business activities that are in a loss situation, I'm going to challenge you to actually look at it and start to figure that out. Because you're going to need to want to have a handle on that as you go forward to 21 and beyond. All right.
Can I ask one question? Just one?
Ask away, please do.
The change in charitable contributions. That's a change in the instructions. I read that and said, I don't agree with that last year. In certain instances, where, what was the business charitable deduction from these pastors? Because many of them, other than I have a few clients that have inventory, that they food products, and they donate those.
And they
so
get
I looked
the
at those as a business charitable contribution. A lot of these editors said, no way, that's not what that is. That's passed through separately. I disagreed with the instructions. Maybe that's just me.
Mm-hmm.
But if you say they're taking it out, are they changing the law? I mean, what are they doing by taking it out of the instructions?
His question is, he didn't do it last year because he didn't believe it was correct. arguable whether or not that was a proper interpretation of the code.
Not by me, but by the IRS.
By the IRS, okay? And well, then you have the exposure
Understand.
of dealing with those penalties that they might choose to assess for willful and intentional refusal to file the rules and regulations. And the instructions are sort of a rule. And not following the instructions exposes you to the 6698 penalty for failure to file complete and accurate, in their opinion. So, if you get audited and if you get challenged, you're going to be arm wrestling on that issue with the agent, their supervisor, and quite frankly, going up the ladder to fight to see whether they were correct in that assertion or not. That was your issue. This is, I think, an admission by the IRS that might have been a bridge too far. They may have overstepped themselves on that one. Because I think when I read that last year and how it came about, I think they simply applied their normal thought process to that. In fact, as a matter of principle, how does the IRS approach any question you ask them? What is their frame of reference? Don't they just think, what is the worst possible result for the taxpayer? That should be the right answer. And I think that's what they did there. Somebody in the IRS, trying, okay, what's my claim to fame? How can I sweeten this? How can I? And that was how it felt to me. And I thought that was a cheap shot and a low blow. And I think they heard about it. I hope that their retreat from that position in this year's instructions actually ends up as, being taken as an admission that maybe that wasn't correct, and we won't have those issues raised by agents on those returns. And if you...
one year where it was one way, and then all of a sudden 19, they slip something in there about that. They just now figure something out, and then they take it back out. That's just not...
It's not kosher.
Not easy to follow.
No. So I'm going to view this as they are retreating from that position, and I don't expect it to be raised on audit. And if I do have it come up with some P.L.S. auditor, I think I pointed...
You meant IRS, is that what you said?
No, I said P.L.S. I meant that, actually, okay? Good catch, though. And I said, no, that was wrong. It was absolutely wrong. And look, they dropped it. They're gone. It's not here in 20, it's not in 21, it's not in 22. No way. And so we go that way up the ladder, arguing with their supervisor and other.
If they ever look at it, QBI is so complicated. I don't know how they track what that number is on the return. It is.
Has anyone seen an audit of 2018 yet on QBI? Well, let's see. The 2018 would have been the first year. Those returns weren't filed until the spring or summer of 19, which means we probably don't expect them to start auditing that until sometime in mid to late 21. So, how they're going to audit, what they're going to do, or anything, I haven't heard any reports for the front on that. It's too soon. I'm hoping this makes a very dumb issue go away. All right. Last thing before we eat. I do hear stomachs growling. Let's talk a little bit about real estate and the real estate safe harbor. And because, this did come through. When we got COVID, I think a lot of people just had other fires to fight, other things to think about. We didn't pay enough attention to this, and I really think you need to To claim the 20% deduction, you must be engaged in a trade or business. The IRS says that means a Code Section 162, trade or business, which is where we get to deduct our ordinary and necessary business expenses, other than the business of performing services as an employee, also known as working for the man. Problem. Although this is a term that's been bounced around in the tax law forever, you do understand there's never actually been a definition of trade or business anywhere in the code or regs. They never got around to it, never bothered. Now, most of the time, that's not a problem. Trade or business is kind of easy. Somebody's got a franchise for like a Subway or Jimmy John's sandwich shop or auto repair place or a landscape. Of course it's a trade or business. It's kind of like Supreme Court Justice P.L.L.'s famous definition of obscenity. He said, I can't tell you what it is, but I know it when I see it. Same here. Usually we know when we see trade or business. It's not a problem. But since Congress and the IRS haven't tried to define it, it's been left to the courts to define. Courts, judges, stinking lawyers. Oh my gosh. This is trouble. I believe that is Supreme Court Justice P.L.L. himself. Now, when the IRS completely ducked the issue, when they put out both the proposed and the final 199A regs, they just ducked the issue. They shirked their duty. And they caught heck for it. And you could tell they were a little sensitive to that criticism. They put this in the in the preamble to the Section 163J interest expense regulations. The most established and developed definition is found in permits a deduction for ordinary and necessary paid and incurred in carrying on a trade or business. The rules under 162 are well established. There is a large body of case law and administrative guidance. In other words, you people are already supposed to know this. Quit asking. Kind of like, your high school student comes in and says, how do you do this division thing again? Well, what the heck are you talking about? You learned division in 4th and 5th grade. Why are you asking me now? You're supposed to know this. That's the IRS's approach. You're supposed to know this. Go look it up. Don't expect us to do it for you. Okay. Well, you look at the case law, the administrative, there ain't no bright lines. And understand that courts, judges, aren't trying to set public policy or broad rules of tax law and construction. They're overworked. They're way behind. They got a horrible backlog. And quite frankly, I can say this, a lot of judges are quite frankly freaking lazy. And they would rather not make a decision at all. They'd rather send you out into the hall and just have you settle it. Go away. Just make it go away. When they have to make a decision, they are only focused on this plaintiff, this defendant, this specific set of facts. And that's, they just got to deal with it and make it go away. Move on to the next one. So, and they are very fact dependent. You need to look at the facts of this case. And your client's facts may be a little different or a lot different. To be engaged in trade or business, the last U.S. Supreme Court opinion on the issue was Grotzinger, 1987. Said you must be engaged in the activity with continuity and regularity. Sporadic activities, hobby or amusement doesn't qualify. You need to have a good faith plan or intention to make a profit, to make money and come out of it. And you gotta work at it. Considerable, regular, and continuous activity is required. Now, if you look back at growth, one of the problems we have is that when the IRS talks about that large and established body of case law and guidance, most of it comes out of the hobby loss rules. Hobby amusement. Now, if you know anything about the hobby loss cases, lawyers have an axiom. You'll learn it first semester when you're there. Bad facts make for bad law. If you know anything about the hobby loss cases, you know they are shot through with bad facts from one end to the other. A lot of those people were doing things that were really stupid, and that doesn't help us at all in trying to get the 20% deduction for our clients. Really hurts. So what it comes down to is, are your people putting enough time and effort into the operation and management activity to show this is a trade or business? And no, you can't use grouping of activities to get there. You can't use the material participation rules of the passive loss rules, none of that. They saw those arguments coming and they shot it down like geese heading south. What it really comes down to is whether this is a trade or business under Section 162 or merely an activity conducted for the production of income, investment activity under Section 212. And a lot of the time that is a distinction without a real difference. You still get to report all the same income, deduct all the same expenses. A lot of time it goes on the same form, same lines. It just doesn't matter. So nobody really cares or pays attention. And he said, well, I'll make the IRS tell me. I'll do a private letter ruling request. I'll lay it all out with facts and documents and send in the user fee. Make them answer the question for me and give me a get-out-of-audit-free card on that issue. Nope. IRS saw that one coming. You know, they have published every year what they call their no-rule list. Questions they won't answer, even if you do a private letter ruling request and send them in a user fee. Guess what they added to it? Yeah, trade or business. You're on your own, boys and girls. Not going to happen here. Well, a lot of the time it's not a problem. We know it. You know when you have business. This has been a real problem for us in terms of real estate. And no, you cannot use the real estate professional rules to get you there. I know. We've all heard the advertisements in the radio and elsewhere. Hi, I'm Dan Merrill from Amy's Hit Show Flip This House. Come to my seminar. I will teach you my secret techniques. Boise is the perfect market to make. Oh, shut him up. God, I'm hearing him in taxis everywhere. Well, you know, if you go to any of their real estate seminars, one of their 12 secret techniques is the real estate professional rule. Because when you are a real estate professional, you are immune from the passive loss limitations. I know, I've heard. And one of their other secret techniques is you don't have to do all 750 hours a year yourself. You can split between your spouse. I know. Well, no, just because you are a real estate professional and immune from the passive loss rules does not get you the 20% deduction. Blew that one out of the water too, didn't they? Yep. Well, the IRS gave us what they called a safe harbor in 2019. I'm not so sure. I interpreted it more as the IRS setting the stage, laying out an adverse presumption for their auditors. that if you did not meet and claim the safe harbor, that their agents were going to be under instructions to automatically deny you the 20% deduction and let you try to argue, fight for trade or business, laying up adverse presumption to use against you. That's how I read it. They've now improved that, made it more formal, Rev Proc 2019-38. Again, they still call it a safe harbor. It's a little better now, but I'm thinking it also establishes an adverse presumption. They say if, and only if, your client meets all of the requirements of the Rev Proc, can you claim the 20% deduction in peace. Otherwise, it's game on, folks. First, you got to define is your rental real estate enterprise, your real estate starship enterprise. This is owning real estate for the production of rents, which sounds a lot like Code Section 212, an activity held for the production of income. Yeah. And maybe a single piece of real estate or multiple properties in your real estate empire. You got to own them directly or through a disregarded entity, a single member P.L.L.C. or a grantor trust in the grantor phase. What they don't want is anybody with a tiered structure. You know, I own 30% of this one that owns 20% of that owns it. There is no safe harbor for that. Those people are on their own, going for it the hard way. Okay? You can either treat each piece of property separately, stand alone as its own enterprise, or you can combine similar ones into a single enterprise or multiple enterprise. Trust me, they need to combine. Why? Because then they can use all of their combined hours to get over the 250-hour hurdle. You don't want to do it on a standalone for each of their 17 rental properties. What's similar? It's only two. It's either residential or commercial. And so you can't put your office building and combine it with your rental houses and duplexes, okay? Those are different animals. And once you begin to combine, you must continue to do so consistently. Professor Vic Stone said, consistency is the hobgoblin of small minds. And the IRS has a very small mind. Now, what about mixed-use property? He's doing one of those deals downtown, or on the edge of downtown, where you take like the 3 to 5 story, the old brick factory warehouse buildings, and he renovates it, puts in the ground floor retail and maybe a very cool brew pub. Gotta have a brew pub on the ground floor. And then second floor offices, right? Very hip. And then in the top floors, we're going to have apartments, rental units, and it's got the exposed brick wall and the wood beams and all. Very hip. All of the young professionals want to live there. Not only because it is cool, but because they can crawl home from the brew pub downstairs at night and they don't have to Uber. Right? This is a cool deal, isn't it? What do you do with that kind of a mixed-use property? The original notice didn't address that. The Rev Proc said, well, you got your choice, brother. You can either treat that entire mixed-use property as one single enterprise, or you can bifurcate it. Take the ground floor commercial restaurant and the office space and treat that as part of your commercial empire, and take the upper floor apartments and treat that as part of your residential empire. So, solely for purposes of whether or not you get the 20% deduction, You will be a trade or business and immune from your auditor's challenge if all of the following requirements are satisfied during the year. This is a year-by-year test or determination. Step 1, you got to maintain separate books and records for each enterprise. That sounds scary and intimidating, but think about it. Don't you already track and report rental income and expenses separately for each property on Schedule E or on the 8825? Sure you do. This is no-brainer. Nobody's going to lose the safe harbor because of this. Not a problem. Then they kind of split the baby. You know, they said they weren't going to give you material participation, which could have been 500 hours or more than 100 hours and more than, they just kind of 250. So, can you show 250 or more hours of rental services for this year? Okay? That's what it is if you've been doing real estate for less than 4 years. You got to have proof, document 250 in that year in order to be safe. If you've been doing real estate for at least 4 years, the IRS kind of adopts, kind of like they borrowed something from the hobby loss rules. You know, the hobby loss rule says, 3 out of 5 years, you make profit, you're good. Say here, you can show that you had enough hours in 3 out of 5. You get the safe harbor even if in 2020 everything worked right. Your client was fully leased. They had no vacancies. There was no turnover. All the tenants were actually paying their rent on time. They didn't have a lot of repairs or maintenance, no storm damage. It was a perfect year. And they dipped down from, normally 310 hours a year, that this time they only had like 220 because everything was perfect. You can dip to 220 periodically and you're still good. You're still safe. Okay, kind of nice. So get your hours in and you are safe harbored on the deduction. Now here's the challenge for your clients. I hope they've been doing it. You must maintain contemporaneous records, time reports, logs, or the like, showing the hours of all services performed, describe the services, the dates, and who done it. Contemporaneous. When you ask your client if they put in at least 250 hours of rental services this year, and you ask them if they have records and documentation for that, if the answer they give you sounds anything like the answer they give you when you ask them about their auto mileage for the year, about the same as last year, 10% more. Okay, do you have a log or record? Well, I can pull that together and get that to you in a couple weeks if I have to. You get that kind of it? You're dead. You're dead. There is no safe harbor for you people. Now, I don't think contemporaneous means they have to do it every week. I like to see it monthly. Usually maybe once a month when they sit down to reconcile the bank account and pay the bills and all. That's a great time to do it. Can you maybe get away with every 2 or 3 months? Quarterly? I hope so. I don't know for sure. That's kind of going to be one of them arm wrestling things with whatever agent you draw, whether quarterly is good enough. I don't think that annually or semi-annually. Yeah, they do it, when I tell them in July on the extended return, they got to, okay, not only did they catch up and finish last year, but they do the first 6 months of this year. And no, I don't think that is going to cut it as contemporaneous and will not get you the safe harbor. Note the statement's going to it has to be attached. This all is going to come under your overriding penalty of perjury signature of the return as both the preparer and the taxpayer. So I want to hear better answers than I hear on their auto mileage. Okay? Now, that was all fine, but how am I supposed to do that for 18 and 19 when the IRS didn't tell me about this till last fall? So they said for 18 and 19 you didn't have to be contemporaneous. They could go back and sit down with their calendar and their bills and their invoices and recreate the hours. But it's as we're sitting down now and we're doing year-end tax planning, and you ask them about whether or not they got contemporaneous records of hours for 2020, if you get a squirrely answer, you're going to have to think about whether you're going to take that deduction for them and who's going to sign the return. Oh, don't worry about it. I'm signing this return. You aren't. Until it turns out that it's October 14, 3 o'clock in the afternoon, and Doug the partner disappears. and my admin assistant changes it so he has to sign it for me. Yes, I've been on the receiving end of that as a senior and manager. People, you want to see the wounds I got? I am all healed. Somebody's got to think about when we're signing that. And if they haven't got it, they better be doing it now, recreating, and telling me that they did it earlier. Get with the program. Now and going forward. Now, you don't have to do all 250 hours yourself. You can have employees. You can have people do this for you. Agents and or independent contractors. Do you think the landscaper that comes out to mow the grass at your rental property or the snowplow driver in the winter, would you consider that your independent contractor? Heck yeah, I would. Who wouldn't? So think about it. The landscaper comes out roughly once a week to mow the grass. 3 people in the pickup truck. They're usually there for about an hour and a half, mowing grass, trimming trees, blowing the leaves and the grass clippings and all. 3 people, hour and a half. That's 4.5 man hours a week. $250 a year, you only need 5 hours a week, people. You practically got it in the bag right there. Oh. Hours, description, the dates, and who done it? Do you know the names of the 3 people in the pickup truck? Probably not. In fact, it changes. It's not always the same 3 people, is it? And who the heck knows who is driving the snowplow when they are plowing our lot at 6:30 in the morning before any of us gets up and gets into work? Oh no. IRS says if the services are performed by employees or independent contractors, I can get away with describing a description of the service, the amount of time they generally spend, and then payment records. So I pay my landscaper X dollars a month, and it's 3 guys in the pickup truck, an hour and a half each. They usually come out on Thursdays, unless it's raining. 4.5 hours a week, and for the month of July, there were 5 weeks. Okay, and you put that down and you schedule it every month. This is why I say once a month, when they balance the checking account and pay most of the bills, that's the time to count the hours on the landscaper and the plumber and the electrician and all the people who are doing work for us. Rental Rental services includes advertising to rent or lease, negotiating and executing leases, identifying information in tenant apps, collecting rent, chasing deadbeats, daily operation, maintenance and repair, management, purchasing materials, and supervising my employees and independent contractors. Okay. Now, this is great. He owns a piece of property, maybe a strip center, and he hires a real estate firm, to be his property manager and to take care. And they handle everything. They advertise, they lease it out, they negotiate with tenants, they take care of the repair and maintenance and everything for him. And they take, 7 or 8% of the gross rents off the top. Sir, do they tell you how many hours they put in doing that? No! The last thing they want to do is tell him how little time they put into it in exchange for 7% of his gross rents. Yeah. So, but now, we got to change, they got to tell us. And if his property management company isn't willing to give him that, and that, then they're costing him 20%. I think they need to be replaced. Now, some things don't count, including a lot of the things that, when we're involved in businesses, accountants do best. Accountant work doesn't count as rental services, okay? Financial or investment management, studying and reviewing financial statements, reports, cash flow, nope. A lot of the stuff the real estate developer does, like arranging financing, procuring property, improving and all that. No, that's not rental services yet because you don't have it in business renting, whatever. And then the last refuge of scoundrels in the passive activity loss rules. Her client says, I spend 2.5 hours every week, usually on Friday afternoon, driving out and personally inspecting all of my rental properties. I'm sorry, windshield time. To and from, when we send young accountants out, they got to go play. Windshield time can be billable hours. It can be billable time. It can be good. Windshield time does not count if you're not providing any services to the rental property or the tenants. Therefore, that cannot be part of your 250 hours. Any property you own as a residence gets no safe harbor. I think this was specifically intended for vacation homes. Maybe they have the ski condo or the beach condo that the family uses for a couple of weeks, but when they're not using it, it's in the rental pool at the complex. No safe harbor there. When you rent something under a triple net lease, no safe harbor. He owns, maybe a big box building, and you lease it to Lowe's, Menards, Home Depot or whatever. How much work does he do? Once a month, he gets a check and he deposits it. In fact, it's probably direct deposited. And once a month, you pay the mortgage. Right? The tenant on the triple net lease does all the work, handles all the repairs, all the maintenance, they pay taxes, they do it all, right? So I can understand why that doesn't get a safe harbor. Okay. In the January notice, the IRS had willfully, deliberately and maliciously tried to treat CAM, common area maintenance charges, and to misconstrue those as being the same as a triple net lease. Really? You know, if he owns a strip center, and you know, he's got leases with his tenants that charges base rent plus CAM, you know, if one of them, you know, leases 17% of the strip center, we have an estimate, and then we figure out at the end of the year what the actual operating costs were, and we compare that, you know, they pay 17% of that. Is that the same as his triple net lease? No! The property owner's arranging for all the snow plowing and the repairs and, you know, insurance. That's not the same as triple net. IRS caught holy heck for this in Baghdad. Real estate you rent to your own business is not eligible for the safe harbor. Well, this is probably redundant because when your client owns the building and leases it to their own business, what kind of a lease do they have? It's triple net. The operating business pays all the bills, right? And the owner gets a check once a month or once a quarter. Okay, I understand that. No safe harbor for that. If any part of the building is treated as being your SSTB, then there's no safe harbor for you. When the dentist owns her building and leases half of the office building to her dental practice and the other half to an unrelated party, maybe an insurance agency, only half of her rental building, the part she rents to her dental practice, is treated as an SSTB. And you find that in the 190 that it says there in the regs, it's pretty clear that if she can somehow establish trade or business, that she could claim the 20% deduction on the half that's rented to the insurance agency. But the IRS says she can't use the 250-hour safe harbor for that. She's going to have to argue for that the hard way. All right. And then you must attach a statement, a piece of paper to the back of a timely filed return, claiming the potential of the safe harbor. The January notice had required this one be signed under penalty of perjury, which meant the statement would have needed a pen and ink signature, which would meant it'd be a pain in the ass to e-file, right? Because you couldn't just do the statement in the software and have it e-file. You'd have to print this thing out, have them sign it, scan it in, the whole attached PDF to e-file, just a pain in the butt. No one doing their own return on TurboTax, was ever going to get that right. And no safe harbor for them. IRS dropped it. So no more separate signature requirement, which makes it e-fileable. Much easier. You gotta submit a statement. It's gotta describe the rental properties included in your enterprise, including the address and rental category of ones you acquire and dispose of during the year. IRS, for some reason, really wants you to highlight the comings and goings in your rental portfolio. I don't know why. It's interesting. And then a pompous self-serving representation that you have complied with the requirements of the RevProc. And this is covered under your perjury assertions in the signature lines of the return as both taxpayer and paid preparer. Think contemporaneous, think hours, all of that. So one last happy thought before we break for lunch. Now that you have claimed the protection of the safe harbor, arguing that your rental real estate enterprise is a trade or business, are you now required to file Form 1099s for all of your payees over $600? You know, a lot of accountants have taken the position for years that rental real estate was not a trade or business subject to the 1099 filing requirement. For those purposes, we said, no, this is an activity held for the production of income. We don't have to 1099. Did you see what the IRS slipped into the 199A regs? Similarly, taxpayers should consider the appropriateness, kind of like your mother saying, you should consider whether, you get the tone here? You better consider whether it's appropriate to treat your activity as a trade or business for 199A, where you are not in compliance with the 1099 filing requirements under 6041. Oh. So, when are those filing requirements due? January 31. So I think you really need to be sure to reach out to your clients with rental properties. And in addition to discussing them contemporaneous records things, and have a conversation about whether or not we're going to be filing Form 1099 for our payments to plumbers and electricians and landscapers and snowplowers and all the rest for 2020. And they need to start collecting those tax ID numbers and social security numbers now. Because the last week of January is no time to try to collect social security numbers from every landscaper, plumber, and contractor in the greater Boise area. Because they won't tell you, they won't respond to anything. They know why you're asking and they're not going to do it. They won't give it to you. But now, your client's got leverage. Your client can say, I'm sorry, I got your check for you, but my accountant says I can't give it to you without a W-9. They got leverage, guys. We can make... Hey, nobody wants to deal with this come January. Okay? They have been warned. All right, with that, it's lunchtime. Out in the hall, we are going to try very hard to hold this to 30 minutes and pick it up again at 12:30.